Good morning, everyone. It is my pleasure to welcome you all to this session on VAT in Qatar. My name is Candice, and I am working with the European Enterprise team at MBG Corporate Services. So you will have the opportunity during this webinar to submit your questions in the Q&A box, which is located in the control panel. And you may send your questions at any time during the webinar, and we will connect with those who send questions after the webinar. So coming to our agenda of the day, I will start by giving you a short introduction of MBG, and then our speaker of the day will cover the basics of VAT, decoding the VAT concepts, and business priorities. So, MBG Corporate Services is a global consultancy firm covering Europe, Middle East, and Asia. We have our operational headquarters in Dubai with offices in Oman, Qatar, India, China, Japan, Singapore, and Germany. We currently support more than 5,000 clients globally, ranging from the Fortune 500 governments all the way to SMEs and startups. To help these clients, we have an in-house team of 600 experts, and which sets us apart is our foreign enterprise group. So we have a framework designed to bridge over cultural, linguistical, and technical barriers. So we have our Arabic team, European, Japanese, Chinese, and Indian with native speakers to support you at every stage. What makes us different is we offer a 360-degree approach, combining not only consulting, but also industry and regulatory experience. And with a wide range of services, we work with companies even before the launch until the various phases of their growth journey. So this makes us unique as we are able to customize our solutions for clients of all scales and maturity across geographies. So as you can see, our services range from audit and assurance, direct income tax, risk advisory, strategies such as feasibility study, mergers and acquisition from both sell side. We have indirect tax, compliance services, and we also have core specific solutions, oil and gas, energy, power, utilities, and other. Then as a firm, we work mostly with sector agnostic, but naturally we have experience on all sectors. And this is a bit about us. And I gladly introduce today's speaker, Mr. Manan Kapadia, Associate Director in Indirect Tax. He is a qualified chartered accountant with over 10 years of experience in indirect taxation. His rich experience in GCC covers jurisdictional on-site VAT expertise in UAE, Bahrain, Oman, Qatar. So I gladly hand it over to you, Manan.
Thank you, Candice, so much, and welcome all the participants. Good morning to everyone. Just share my screen. So today's topic about VAT in Qatar. We would start first with what the VAT is prevailing in the GCC. So a brief about that. So in terms of GCC VAT, we know that the GCC countries have signed a GCC VAT agreement. In 2016 itself, it was signed. After that, we saw UAE and Saudi going ahead with VAT implementation in 2018. Bahrain followed in 2019, and then last one was Oman, which did it in midway in 2021. We anticipate VAT coming soon in Qatar, and we'll discuss about that in the slides ahead in terms of what are the applicable scenarios at the moment and what are the business priorities as well. So in terms of VAT, as a start, what is VAT? It is value added tax. It's a consumption based tax. It is applicable on all your business transactions, including your imports as well, and including deemed supplies. So it is charged at each and every stage of your supply of goods and services, and every VAT registered business will require to charge VAT as well. But is it supposed to be a tax on business? No, it is an indirect tax. So that's why it is actually being consumed by the final end consumer like us. So it is something which is actually being borne by the final customer when they go to the market to buy some product or services. They are the one who actually pay the VAT. And businesses are more like an agents of the government to collect that VAT and remit it to the government in a timely manner. There are certain different types of supplies. So basically, it's not one standard 5% VAT rate, which we anticipate to be coming in Qatar. Yes, standard rate could be 5%, but there are some supplies which are even taxable at 0%. Some are exempted from VAT and some are considered out of scope. So I will cover those as well in the slides ahead with examples. Output VAT is basically the tax you are actually going to charge on your revenue on your sales. So when you are going to raise invoice to your customer, you will be charging output VAT, let's say 5%. And when your vendors will be charging you, your suppliers will be charging you, it becomes an input VAT. It's basically a tax you have paid to your vendors on your purchases. Now, just going through some of the VAT concepts. You all can always raise your hand and if you all have any questions. Otherwise, even at the end, we have a Q&A session where dedicated you all can reach out and in terms of if any queries you can ask. So VAT registration threshold. Right now, we have determined Qatari riyals 364,000 as the annual turnover, which is requiring you to register for VAT on a mandatory basis. Meaning that if you are in a business which has taxable supplies, taxable turnover, which is on and above 364,000, then you are mandatory required to register for VAT. And this includes 12 months prior or 12 months forward. However, if let's say you are below this limit, in that scenario, you have another option of voluntary VAT registration. So in this case, apart from your turnover, even your taxable expenses are considered in the threshold, and it's almost half. So if you are crossing 182,000 Qatar riyals in a year, and you reach up to that limit, you can still opt voluntarily to register for VAT. Below 182,000, you cannot register. So very few smaller shops you will foresee that they will probably not register for VAT, but most of your suppliers would be registered for VAT. And it is very important that businesses understand that even if they don't have a taxable turnover, you have a voluntary option to register for VAT basis your taxable expenditure. So we have seen many startup companies, many construction companies, which misses out on getting registered for VAT. And what happens in that process is that you end up becoming like an end customer because your suppliers will continue to charge VAT on your expenses and you are unable to claim the same. So that results in extra cost for you and you become the end customer, which is not the purpose of VAT. So even construction companies or startups which have no initial revenue, they should also opt for VAT registration using the voluntary registration limit, using their taxable expenses as a base. So that's about the registration threshold. In terms of VAT applicability, so it is very critical to know in terms of how VAT applies. Is it applicable on all the transactions? And how do we determine what should be the rate and when it should be charged? So there are three core concepts of VAT which should be applied in each and every case. And there are specific rules provided in the laws and regulations about this in the GCC. So the three concepts are as follows. As you can see on the slide, we have first one is place of supply. So place of supply are the governing provisions which determines where VAT will be charged. Now, each country would want to collect VAT, but all the transactions cannot be subject to VAT. If you have cross-border transactions, if you're into importing or exporting something, then in that scenario, you need to determine which country has the right to charge VAT on it. Does Qatar have the right to charge VAT on a particular transaction when maybe the supply might be taking place in Saudi Arabia when they are exporting something? Will VAT be charged on it or no? So there are place of supply rules for each product, each service, each type of transaction, whether you are transferring goods or you're supplying services, how the services are being supplied, where they are being performed, where is the asset located on which the service is being performed. So it has multiple parameters which are involved, which you need to evaluate for each and every transaction to determine what is the place of supply for that particular transaction. If you establish that the place of supply in that particular transaction is Qatar, in that scenario, VAT will be applicable in Qatar. Once that is determined, now you need to identify whether it will be taxable at standard rate, which we assume to be 5%, or it will be taxable at 0%, or whether it will be treated as exempt, So those are the various scenarios you will have to evaluate after determining the place of supply. Once that is determined, let's say the transaction is applicable at standard rate of 5%. In that scenario, you need to now ensure when VAT will be charged, right? Now you have determined first scenario, VAT will be charged in Qatar. But now second thing is when you will actually pay, when you will actually collect from your customer, when you will actually pay to the GTA in Qatar. So that is governed by date of supply rules. Just like place of supply rules, there are date of supply rules for each and every type of transaction. So you have to determine using your own transaction, you need to link it to those particular rules, and then you will get an understanding when is your business required to raising the tax invoice, when you are required to charge VAT, when you are required to charge and collect it from your customer, and when you most importantly you are required to pay to the GTA, the General Tax Authority in Qatar. So those are actually driven by the date of supply provisions. And it is different in case of services, it is different in case of goods. It is always something you need to track in terms of what are the earlier of any events. If you are performing some service, if the service has been completed, maybe your invoicing terms might be different, so you may raise it as per your billing milestones, which may be later. But the VAT rules may require you to raise the invoice now. So you need to relook at your contracts and revisit your payment milestones as well, your invoicing terms as well, whether they are aligned with the VAT requirements. So those are the things which are very critical you need to observe while determining your existing contracts as well as future contracts. And finally, on what value you will pay the VAT. So what is the consideration you need to pay VAT on? So it is basically the invoice value in most scenarios. In case you are receiving advance, in that scenario also you need to pay VAT on advance as well. It may not be treated as a revenue in your books of accounts as per IFRS or accounting standards, but for VAT it is treated like a revenue. You need to raise a tax invoice for advance, and then you need to pay VAT on that in that particular VAT return as well, which may be monthly or quarterly. So those are the things you need to keep in mind. Even value of supply, basically, it means the consideration you are receiving for it. So it may be at times you may provide discount to your customer. In that scenario, you have the benefit of applying after the discount has been provided on the invoice itself. So it will be on a net value after discount. But what about a scenario, let's say, where we have a consideration which is zero? You are giving free supplies, maybe a promotional item, free supplies, free samples, free gifts. In that scenario, will VAT be applicable? So the answer is yes. The governing provisions states that even if it's a free supply, it will be treated as a deemed supply. You need to identify if you have claimed corresponding input VAT on that particular product or service. Then in that scenario, you need to identify the cost of that product and apply VAT by yourself and pay it by yourself. So for that purpose, you need to ensure that all the transactions are captured. You will have to even raise invoices and report it in the VAT return as a standard rated supply. So value of supply is also critical. You will need to ensure you are considering both consideration monetary as well as non-monetary. And where there is no consideration, also you need to look at the deemed supply provisions under the VAT laws, which will give you guidance on what should be the basis of the VAT treatment as well. As I explained before that we have different types of rates. So this is like a slide which states about the UAE current VAT rates which are prevailing, and we have 5%, we have 0%, we have exempt supplies. So in terms of zero rated supplies, so we see that certain basic necessary based supplies have been zero rated, meaning VAT will be charged at 0%, like educational supplies, healthcare, medicines. If you are exporting goods and services also, you need to verify whether your conditions are satisfied. In that scenario, you might be eligible for zero rating. If you are into oil and gas sector, you may have certain zero rating benefits as well. International transport, like our air tickets, etc., would also be beneficial in terms of zero rating. So that means that VAT will not be charged on that. There are certain services which are exempted, like financial services, bare land, like bare plots. You have local passenger transport, our residential property where we pay our rent, residential rents. So those will be exempted from VAT, meaning there will be no VAT charge on supplies by the supplier. And obviously, apart from that, if it is not either specifically covered in zero rate or exempted, and if, like we determined before, list of supplies in Qatar, in that scenario, it will be applicable to standard rate, which will be likely 5% in Qatar. So that's in overall about the type of supplies which are 50 and exempt. In terms of VAT recovery, so it is critical to know how we can incur the input VAT which is being charged by our supplier. It is not straightforward that in all scenarios you can claim your input VAT. So if your vendor is charging you VAT on his invoice, there are multiple parameters you need to keep in mind. So this is where your accounts department, procurement department also needs to be very, very careful that when they are receiving the invoice, they should ensure that they verify the details of the invoice, whether they are in line with the VAT requirements. Tax invoice should be received. It should not be like a pro forma invoice or a commercial invoice. Now, going forward in VAT, there will only be tax invoice. And even if you are paying advance to your vendor, you need to ensure you get the tax invoice from your vendor so that you can claim that VAT. By merely paying the advance, you cannot claim the VAT. You need to be in possession of a tax invoice. So wherever your commercial terms might be that it allows you to pay after maybe 3 months or 6 months, in that scenario also you need to establish records internally that you have made an intention to make the payment within 6 months. This is as per UAE. Every other country may have different rules. Like Oman gives you 3 years timeline. Other countries have different timelines as well. So Qatar may have a different timeline as well in terms of recovery of VAT. So in case you are missing out on something, you still have maybe 1 or 2 more tax periods in case of UAE where you can possibly claim the VAT as well again. So wherever you are incurring VAT, which is for business purpose, which is linked to your taxable supplies. If you are into mixed supplies, like for example, you may be into supply of financial service as well, apart from some other products as well, which are taxable. So you have both taxable as well as exempt turnover. So you can only recover VAT to the extent of your taxable turnover. You cannot recover for services or products which are exempted. So in case you have incurred VAT which are linked to your output which is exempt, in that scenario you cannot claim VAT. So that is something also very critical which businesses have to ensure when they are doing their compliances. They calculate the eligible input VAT which they can claim, and you need to even ensure you do an annual adjustment about it so that accurate turnover is available at the end of the year and you can claim only to the extent which is linked to taxable supplies. So those are procedural aspects and compliance aspects which have become very critical in case of input VAT when they are into mixed supplies or a business is into mixed supplies in terms of taxable as well as exempt. Then you have certain credits which are categorically stated as non-recoverable, meaning you cannot claim input VAT on it even if it is charged by your supplier. So this becomes extra expense for a business, for the company. So when you are basically giving some entertainment service, maybe throwing some parties or some dinners, etc., and in that scenario, those are treated as entertainment expenses and you cannot claim VAT on it. Also, if you have given some products or service to your employees without any charge to them, in that scenario also, you need to be careful that whatever you have procured, you cannot claim, or else it will come under the purview of team supplies where you have purchased a motor vehicle and it is available for personal use of the employee as well. Maybe the key management staff might be provided by the company to have a motor vehicle. It might be registered in the name of the company. You might be claiming depreciation on it. Still, If it is available for personal use of that employee, they can take it back home, use it on weekends. In that scenario, it is available for personal use, and that's why you cannot claim the related input VAT charge by the suppliers. It may be related to the purchase of car, it may be related to repairs and maintenance, insurance, any servicing, etc. You cannot claim input VAT on it. So they are specifically locked credits. So these are just some examples. You may have other expenses which may be similar in nature where you cannot link it directly to business purpose. So it's very critical to evaluate your entire expense register to see what can be claimed and what cannot be claimed. And in case it can be claimed, what are the documentation you need to maintain? How you need to ensure that you are being able to be compliant in order to claim the VAT where you can. And that way you will even ensure you are not claiming something incorrectly so that you don't get penalized or fined later on at the time of assessments and audits. Then we have a concept called reverse charge mechanism. So reverse charge mechanism in VAT is a process where buyer instead of the seller is responsible for reporting and paying VAT on imported goods or services. So in normal scenario, as we see, it is always the responsibility of the supplier. So a business which is supplying some product or service is always responsible to get registered for VAT, and they will have to charge on their invoices and the customer will pay. But reverse charge mechanism, as it is stated, it is reverse charge. Basically meaning that the liability responsibility has been shifted from the seller to the buyer. Why is it done? Because the seller is actually a non-resident. They are not having any presence in Qatar. They are outside Qatar. So, like we see the examples given here, you may have a US-based service provider who is providing professional services to some a company in Qatar. In that scenario, the company which is registered for VAT in Qatar will be the one reporting VAT and taking account of the VAT in its VAT return, and not the US based service provider. They will have nothing to do with VAT. But the company in Qatar will have to ensure the documentations are in place. They are converting the foreign currency into Qatari riyals as on the date of supply and reporting it into the VAT returns, ensuring that they have checked the eligibility of even taking the credit of it. So, in a way, what happens is in reverse charge mechanism, it is more like a reporting requirement rather than any cash flow or financial implications. This is in case of services. In case of goods, so let's say you may have someone who might be in GCC or outside GCC who are supplying goods to you when you are in Qatar. So you are importing goods in Qatar. Again, reverse charge applicable. That entity supplier will not register for VAT in Qatar because you are registered as a customer in Qatar. So you will be required to pay VAT at the time of customs clearance. In UAE, we have the concept of reporting it through the VAT return. So if your customs code and TRN, your VAT registration numbers are linked, then you have the benefit of not paying any VAT at the time of clearance. It is directly populated in your VAT return. So that helps you in terms of avoiding any cash flow implications and financial implications. However, other countries may have other options, like Oman may ask you to actually pay VAT, but there are also other options in terms of you can opt for VAT deferral also in certain scenarios. So overall, it ideally should not become a cost for you, and in a way you can claim back the credit of whatever you are paying even though it is under reverse charge mechanism. So you will create a liability and simultaneously you will create an asset also in your books. So effectively your net impact remains nil. We discussed date of supply rules before, and that is applicable in case where you have VAT in Qatar and it is live, and it is for any transaction which has started only during the VAT regime in Qatar. But what about a scenario where you have active contracts, ongoing contracts, which are long term in nature, where you already initiated your service and it is going to continue maybe even during the VAT regime? So, right now, you don't have VAT, you are raising invoice, maybe you're receiving advance, you naturally don't look after VAT on it. But when VAT comes, how will this contract be impacted by it when you are actually providing the services, when you are actually receiving the payment. There are various factors you will have to determine here: when the invoice was issued, when the payment was received, when the actual supply of goods or service took place, to determine the tax point when actually you need to pay VAT. So the law will cover a separate specific VAT transitional rules. So these are called transitional supplies, initiating before VAT and continuing in the VAT period. So you will have separate specific transitional rules, and depending on your supply, whether it's a goods or service, whether it's a one-time supply or it's a continuous supply, as normally seen in long-term contracts, you need to apply the VAT rules over there to determine on what portion VAT is actually applicable, or whether it will be completely exempted from VAT. So whether I can take any benefit, or what are the changes I will have to do in my existing contracts to safeguard myself from VAT when it comes. Because customer may not agree to paying VAT in the VAT period because your contract is already signed. So many times we observe from our clients that the contracts are not covering VAT clause, or they are treated as tax inclusive, VAT inclusive. In that scenario, it will be a direct hit on your revenue. So you need to determine whether VAT is applicable on your supply, and if there is any possibility, you need to reach out and renegotiate with your customers to safeguard yourself that if VAT comes, please allow us to charge VAT, and you can possibly claim it in your VAT return as input VAT, as a credit for you. So those are the things which businesses should be paying attention at the moment, so that they are safeguarded from VAT if it if and when it comes in the near time. So coming to the last section for today, and this is related to business priorities. What businesses need to do in terms of VAT readiness. Why are we speaking about this topic today? And we are listening about VAT since 2016 in Qatar, but so far no substantial announcement has happened. So why are we having this topic being discussed? So let us focus on how it was implemented first in other GCC countries. So why we say that businesses may not have sufficient time in order to be VAT ready. So let us look at how other countries implemented VAT. Like Kingdom of Saudi Arabia, they implemented VAT on 1st January 2018. The law came 5 months before VAT implementation, and the regulations came 4 months before. I believe this was something sufficient timeline for businesses to prepare. However, same time UAE implemented on 1st January 2018. The law was published 4 months back, but the executive regulations, they were published almost 1 month back. Now, what is the difference between law and regulations is law is more like a standard document in terms of what are the basic principles which needs to be covered. However, the detailing, the rules, the procedural aspect will come in the executive regulations. What should be included on your tax invoice? When you should be raising the tax invoice? There are timelines for it. Like in UA, you need to raise a tax invoice within 14 days when your date of supply triggers. So this timelines, this processes, the detailing part comes in the regulations. Bahrain, they implemented 1 year later in 2019. Law published 3 months back, regulations on 13 December, like 2 weeks before the implementation date. So you can imagine how tough it must have been for businesses to prepare over there for VAT. Oman, they implemented midway, 16th April 2021. It was the month of Ramadan when it was implemented. The regulations came out 1 month back on 10th March 2021. It became very tough at that time. And still, even during the assessments and all, because you don't have your VAT returns for 1st Jan to 15th April. However, your audited accounts are from 1st Jan to 31st December. So there is always some reconciliation gap, and which is difficult to justify. So something similar can be expected as well, that it can happen in Qatar as well. So what are the recent updates here in Qatar? So if you are using the Riba tax portal for your corporate tax or withholding tax or contract reporting or any other service like transfer pricing, in that scenario, you can have a look now. Even your Dariba tax portal has updated VAT in it. So value added tax is added as a section in your My Profile section. This is basically a screenshot of that, which is about VAT registration. So these are the details, basic details which they will actually ask for at the time of VAT registration. Obviously, these are just some basic details. There will be other documentation, etc., which will be there. A formal link will be there to register online as well. But this is a strong indication that we have been hoping, okay, something concrete should come, something should be visible in terms of VAT in Qatar. And this is one big highlight about VAT in Qatar, which is already available. You all can always go back and check in your login details on the Riba Tax portal in your My Profile section. You will find a VAT drop down also added. Click on it and you will see these details. It is kept inactive as of now, but it is ready. It means the government GTA is ready at its back end in terms of VAT preparation. So it's a strong indication that businesses should also prepare for it. So what we recommend as MBG is what businesses needs to do is you need to plan and analyze. You need to identify your project resources, who should be the one taking care in terms of your key stakeholders. You need to assess the impact of that across your supply chain, income, expense, even your balance sheet item. All your income and expenses needs to be verified. All your contracts needs to be reviewed on a sample basis to cover all types of transactions. You need to check whether you need to amend your contract. You need to safeguard, especially about the transitional supplies like we discussed. Those are very critical. So those are the things you need to assess in your phase one, which is VAT impact assessment. Then you move to phase two, which is more towards your IT part. Your software needs to be upgraded with VAT requirements, especially again with the transitional supplies. You may have existing software with certain VAT fields, but that does not work. You need to have specific implementation for transitional supplies, your existing contracts, and that is very critical that you implement it and keep it ready. So currently what we suggest to businesses is go ahead with the VAT implementation, VAT readiness based on existing GCC laws, because more or less 90% would be similar. So at least you will be 90% ready. And like we saw in terms of the timelines provided in terms of implementation, even if the regulations comes like 1 month back, your IT team, your staff will have sufficient time to implement and you will have a smooth transition. So that way also we can even help give training to your staff and obviously will help you with VAT registration and VAT compliances once the VAT is announced and in place. So this is like a three-phased approach overall. And first is your VAT impact assessment, second is your VAT IT implementation, and third is your VAT post announcement, which is VAT registration and your compliances. So that's an overall about VAT readiness, what businesses needs to do. And thank you for listening patiently. Now I would open the door for any Q&A if we may have. Feel free to ask.
Thank you very much, Manan. Thank you all for attending this webinar as well, and we hope you find it insightful. If you have any queries, please feel free to drop them in at qatar@com or visit our website www.mbgcorp.com/Qatar. So we will continue to share your knowledge with all of you by organizing more webinars and seminars and workshops. And yeah, please feel free to follow MBG Corporate Services LinkedIn page to be up to date. So thank you once again to all the participants. Thank you for our speaker, and I wish you all a great rest of the day. And see you next time.
Thank you, everyone.
Thank you.